There's a curious pattern in the behavior of financial markets. For long periods, everything seems stable. Indexes rise, investors grow confident, and the dominant feeling is that risks are under control. Until suddenly, something changes, and the market realizes that a global risk had been quietly building. The history of the market is full of these moments. The problem is that global risk almost always becomes obvious only after prices have already started reacting. And that's why some analysts have begun asking a very important question. Could there be a global risk today that the market has not fully priced in yet? Hi, my name is Chad, and here on the Global Markets channel, we bring information with a single goal: to help you become more critical about the market so you can make your money take off. When we look at the recent behavior of the markets, we see a seemingly optimistic scenario. U.S. indexes remain relatively strong, economic growth continues to show resilience, and many investors still maintain a positive outlook for the future of the global economy. But at the same time, when we widen the lens beyond short-term charts, we began to notice that some structural tensions are slowly building within the global economic system. These tensions may not yet appear clearly in prices, but many strategists are starting to discuss whether they can become a significant global risk in the coming years. In this video, we're going to explore what that potential global risk might be and why it may not yet fully be reflected in the markets, and how institutional investors typically analyze this type of threat before it becomes obvious to everyone. To understand why a global risk can remain under the radar for so long, it's important to look at how markets typically operate. Most of the time, investors are focused on more immediate factors: economic growth, corporate earnings, and the monetary policy decisions. As long as these elements appear positive, many structural risks tend to remain in the background. This behavior creates an environment where certain vulnerabilities can slowly accumulate within the global economy. Geopolitical tensions, elevated levels of debt, or shifts in production chains, for example, can develop for years before directly impacting markets. During this period, the global risk exists, but it is not yet fully reflected in the prices. What usually changes this dynamic is the moment when these factors begin to affect concrete data or growth expectations. And when that happens, the market goes through a rapid reassessment process. A global risk that once seemed distant can suddenly be priced in within days or weeks, which explains why many market corrections happen so abruptly. For this reason, institutional investors dedicate a significant portion of their analysis to identifying potential sources of global risk before they become obvious to the broader market. It's not necessarily about predicting crisis, but about understanding which tensions may be quietly building behind an apparently stable environment. The central point of this discussion is not to predict exactly when or how a risk might materialize. History shows that financial markets are extremely complex, and crises rarely unfold exactly as analysts expect. But understanding the presence of potential vulnerabilities in the system is an essential part of long-term analysis, because often the real advantage of an investor is not predicting the market's next move, but recognizing when a global risk begins to quietly accumulate behind an apparently stable environment. And the earlier this type of analysis takes place, the greater the ability to interpret important shifts in market dynamics. If you want to understand how major investors analyze global risk, the structure of the economy, and the real forces behind market movements, follow Zero Markets. Our goal here is not just to watch the charts, but to understand the forces that truly shape the global financial market.